All right, everybody, welcome to the second episode of the Smart Trading Concept. And in this episode, we're just gonna dive right straight into what microstructure is. Um, Please, I'd like to announce to everybody, if you haven't watched the episode one of this series, please, I strongly suggest that you go and watch it, and if possible watch the introduction of this series, this course, because it is going to do you a whole lot of good. Market structure and technical analysis, which you cannot do without as a forex trader. When you come to your chart in the morning every day, you should be able to identify what is the current direction of the market. Are we buying or are we selling? Now, if you haven't watched the candlestick anatomy, this term is going to be a little bit strange to you, but do not worry. When I say buying, it means the market is bullish, and when I say selling, it means the market is bearish. Now, before I proceed, there are some terms I'd like to introduce you guys to. You see LTH, and then next to it, we see STH slash STL. The LTH here stands for long term high, okay? And then the LTL by the right here stand for long term low. Now inside the LTH and inside the LTL, we have STH slash STL, and then we have STL slash STH. What does it mean? The STH simply means short term high, while the STL means a short term low. Now, if you turn to the right, it is kind of inverted. So instead of STH here, we have an STL before the STH, which stand for a short-term low slash the short-term high. So the question is, why is it labeled like this? When we are trading up, okay, when we are buying, when the market is bullish, okay, there is more strength to the short-term lows until the long-term high is either broken or taken off. That will make sense a little bit. Now, before we dive too deep into this market structure, I'd like us to, I'd like to introduce you guys to some terminologies here. Number one, break of structure, BOS. Number two, change of character, or better, you could just call it trend change, TC. And then the BOS also, you can also refer to as SB, structure break. Then there is going to be higher highs slash higher lows, and then there's going to be lower highs slash lower lows. Now, I do not want you to be confused of these steps. They are simple. These are just terminologies used to describe structures of the market to make it readable and understanding. Okay. Now, this is just a basic introduction to market structure. We are going to, talk a lot about market structure because this is the backbone of a successful trader. So LTH, long term high. What does it mean? The long term high, when you are looking at the price chart, the correct time frame that you're looking at the price chart from, okay, the highest swing high, okay, of that time frame, okay, is what referred to as the long term high. In this case, this guy here. So this is the highest swing point that price has traveled to before it is beginning to retrace down. Okay. And then this is the lowest point price traveled from before it got to this high here. Now, another thing I want you guys to also keep in your mind is this: forex market is not always going to, trade for one direction indefinitely without retracing back. Now, there are terms like retrace, retracement, okay, and then we also have continuation. So, what is continuation? Continuation is um the continuous direction of the market. For instance, if the market is going up high, that is, it is continuing to the upside, it is distributing to the upside. So I'm also going to write down that distributing, and then there is also going to be a retracement. The retracement is something like selling off. For instance, since the market is bullish, the retracement is selling off, okay, before resuming back to the to the current trend, before continuing to the right direction that is going to. So in the case of this market direction, we are actually pulling, because you can see from the previous swing levels here, we had a swing high, a swing low. We had the next swing high here, and then a swing low, and then we went to the upside, swing high, swing low, and then we're preparing to shoot to the upside again to have another swing high. Okay. Now, after a completion of a swing high, since the market is bullish, when the market breaks above a particular swing point or swing level, there's going to be a deep retracement. So this is what we mean by when we say a break of market structure. When the market breaks above a recent high or a recent low. Now, please, I'm going to be making use of highs, and I'm going to be explaining in terms of a bullish market because of the current trend direction. Okay. But bear in mind, whatever we talk about when the market is bullish is also what we're going to, refer to, but this time around in an opposite direction if the market is bearish. So the same way we have break of structure, okay? If the market is trading downwards, if we have a break of structure, then the long term swing high. So this high is going to be protected, and then we're going to be breaking below, breaking down, breaking down. So the overall here, the explanation, what I'm trying to drive out is this, okay? If the market is trading up, so I'm just taking back to where we're coming from. If the market is trading up, these lows, okay, since it is bullish, the long-term lows are going to be protected regardless. Okay, no matter how deep the retracement is, the long-term lows are going to be protected. So I'm going to mark out all the long-term swing points. So when I refer to a swing point, it is either a swing low, a long-term swing low, or a short-term swing low, or a long-term swing high, or a short-term swing high. So they are all referred to as swing points in general. Okay. So I'm going to mark out all the long-term swing highs and long-term swing lows. In fact, that we're currently having. As you can already tell, this is the 4-hour time frame. If you look up here, this is a 4-hour time frame. We are day traders. What we usually mark, where we mark our structures from, is the M15 here. But that doesn't mean that you're not going to scale up high to see what the bigger picture is, because the higher time frame is always going to be the captain over the lower time frame. Okay, we're going to come to there. We'll explain everything down. This is just an introduction to market structure. Bear in mind. So this is a long-term swing high, higher high. So the long-term higher high. Okay. Now inside this box, now look at what is happening. Inside this box is where we're going to be having our short-term high and our short-term lows here. Okay. Now look at what something I want to show you guys something. How do you determine a long-term swing high and a long-term swing low? This is very, 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 very important. Okay. Here we have a recent swing low, and after this recent swing low, we have another swing low. But before we had this swing low, there was a break above this short-term swing highs here. What it means is this: whatever is happening inside this place, all right, belong to the family of this guy and this guy. Okay, so right inside the long-term swing points is where we have the short-term swing points. Why is that? The short-term swing points are what forms a long-term swing points. And to form a long-term swing point, a short-term swing level must be protected. A little bit confused. Now, for this demonstration that we have right here, let us assume, okay, fine, this is we already broken to the upside. So for the long-term picture, this swing low is going to be protected. And now we're going to have work to be done in the middle. permit me to take you back to the candlestick anatomy where I told you guys that whenever you want to trade, whenever you're trading any asset you're going to be trading, you're definitely going to be trading just one particular candlestick. Be bullish, be bearish. Okay? It is what candlestick that you're going to be trading. So remember in the candlestick anatomy, if this is assumed to be bearish, this is going to be the opening, this is going to be the high, all right? This is going to be the low, and this is going to be the closure of the candlestick. And it's going to look like, it's going to look up something like this. The opening here, the high, the drive to the down low, and then the close there. Okay, so please, if you haven't, okay, if you do not know anything about what I just drew here, refer back, please refer back to the candlestick anatomy session, and everything will be clear over there to you. Okay, now to form this candlestick, a lot of work, okay, has to happen under the hood. Why is that? Simply because in the forex market, it is not just one participant. There is a whole lot of participants, okay, in the market. We have buyers, we have sellers, okay. We're going to have a lot of disagreement. We're going to have a lot of fear, a lot of uncertainty, a lot of doubt, a lot of greed. So all these together are going to affect the way the market behaves. However, for the forex market to keep running 24 hours, we need the big players, the big parties, who are referred to as the institutions, okay? The hedge funds, the banks, whoever they are, the big players, because they are the ones that actually has the power to move the market, not you and I. Remember, we have the retail traders and we have the institutional traders. Here in STC, we follow the footprint of who the winner is, who the bigger player is. And another thing that you must consider is this, okay? The fact that we name some of them big player, it is just a general category of the players of the market. So we have two categories. We have the institutions and then we have the retailers. You and I, we fall into the categories of the retailers, and then the bank, the hedge funds, whoever they are, bank A, bank B, bank C, bank D, money lenders one, whoever they are, they fall into the categories of the institutional players. These guys do not see themselves. In fact, they're enemies as far as market structure is concerned, or as far as forex market is concerned, because they're going to be trading against themselves. Okay. Now, what happens is the biggest player, whoever has biggest money, drive the market to their favor, to their direction, to wherever they want the market to go to. And those directions are what you and I are going to be trading alongside with. Because if Bank A wants to buy the market to the downside, okay, wherever he's buying the market from or wherever he's selling the market from, he will have to protect to make sure that he doesn't lose any money. Okay, in this scenario, Bank A is buying from here, so we'll label this place now A. Now this is A. A is buying. A is buying all the way from this level to this level. That is the intention. Now it doesn't have all the money to buy from this level to this level. However, it has a lot of money to put into the market. Okay. Now Bank B steps in. Let's assume Bank B stepping from this level here. So Bank A is not going to let, come on, refresh. Yeah, it's not going to let Bank B to come take away this level here. Because if Bank B come all the way to this level to strip this level away, Bank A is going to be losing a lot of money because it took him or it took this institution a lot of money to push the market all the way from this level to this place here. Now, that is structure one, or that is one illustration on its own. Now, there's another illustration as well. For Bank A to succeed this market, even if he has a lot of money, if he lose concentration, and you can see there is a lot of white candles here pushing to the upside, there is no much of sellers down here. What he can do is this: they will pause for a while and then invest more money to pretend as if they are selling. And in the general term of smart money concept, this level is referred to as inducement level or liquidity pool or market red. Yeah. Don't worry, we'll get to this level of just marking so that it makes the whole thing easier for you to understand, to swing along. Okay. So they were going to invest a little bit here. And what we're going to be having here is a little bit of consolidation. Now, the reason why we're going to be having a little bit of consolidation is because the money they have is to buy, not to sell. Okay, selling against themselves is kind of, it doesn't make sense to them. Of course, they're not going to be losing money, but if another bank that is bigger than this guy sees the opportunity to launch a deeper sell, they're going to lose a lot of money. And then to push the market back to the upside, they're going to need extra money. So if they used 500 trillion dollar or maybe million dollar to push the market from this level to this up here, if another bank push the market down, they're going to need double of that money to beat the bank B to push it upside. Now, understand what is happening during the process of this up movement. You can see we have some pullbacks here. Okay, this is this is a pullback. We're having some pullback. This is a pullback. It is protected. The market traveled all the way to this level, and here it was protected again to this level, and then a little bit of investment. It was protected until it got to this high here. Immediately the market got to this high, it started retracing. Remember when I said market cannot just go infinitely to the upside, it has to be retracement, and then we're beginning to have a deep pullback. These guys that did this short-term investment, now for the fact that I made sure that Bank A bought the market to this upside doesn't mean that it's only Bank A. Bank B might actually see the same opportunity. Now, instead of fighting Bank A, what they do, they can actually be the one. You might be surprised that it's actually Bank B that invested in this level here, Bank B. Okay, they drop into money to attract more sellers, so they can manipulate the market, and then do whatever it is. But when we'll get to that part where we have manipulations and fake outs, we're going to deal with those parts, okay? So Bank B can also be part of this move. Bank C can also be part of this move, just to make sure that the move drives up to wherever they want it to drive into. And at the end of the day, they are going to distribute the market, okay? Distributing means selling off for a short period of time because the intention is to drive prices higher. So the higher the prices, the higher their profit. Now, take a look at it. If they buy from this level and the market happens to, go higher and higher to this level, what happens? They're gonna make ton of money, a lot of money. Okay, because they increase the value of this asset here, gold. Okay. Now they cannot just buy like a ruler, like an express all the way to the upside here. They don't have that kind of money. They're gonna sell. As the market goes on, they're gonna sell. Okay. So in the scenario that we have here, because they've already hit the peak of where they want, and maybe they out of cash, or maybe they want to sell off to, get some money, pay their staff, they will start selling some parts of their assets away and then taking off their investment also. They sell down to take away this investment. In some cases, they might even sell that to take also this investment before. Did they even sell? Let's see. Aha, you see? They take away all this investment, okay, before resuming to the director. Because don't forget, this is an investment. This is not a retracement. It's not a full-time retracement, although it's a retracement, but it's just an investment. A full retracement is the one that goes deep. Usually take away this investment level where they rip out the money, they harvest their money, they harvest all their assets that they invested. Bank B invested there, have had to harvest. When Bank C invested here, they have to also harvest the investment like that, until they hit a particular level before resuming to the current direction. Now, that is number one explain. The number two that I want to explain is this. During the time of the uptrend, okay, there are some levels, some swing level that has to be protected. Okay. Now I made me sure that if Bank A do not have a lot of money, B can actually come to swing them away, and they they start they'll be experiencing a lot of loss. Okay, to push the market back up, they're gonna need a lot of money. Now they've allowed the market to fall down to a discount level where the price is sort of cheaper. Don't worry, everything that I'm bringing right here, don't worry about it. You're gonna learn it. This is just an introduction. Okay. They allow the market to fall down to around 0.618, close to 0.705. That is a lot of discount level there. But then after they see that okay, it's cheaper for us. I'm sorry, it's cheap for us to buy from here again. They launch another buy, investing a lot of money. By buying this low here is then going to be protected. That is what I'm trying to explain. The swing lows that matters, the long term, the long-term lows, okay, are going to always be protected as long as the direction of the market remains bullish. Now that it's changed, the direction is changed because initially there was a retracement to the downside, and if you look closely, it was being protected. Look at this. Look at what happened until they hit this particular low. This low was protected. Sorry, this high was protected. This high was protected until they hit this low, and then they took a deep retracement. Now, whatever happens on a big time frame also happens on a smaller time frame. Okay, that is why market structure is a lot confusing because you're going to have retracement here and there, retracement inside retracement. If I scale this time frame to a 1 hour in time frame, you're also going to be, amazed because it is still going to be retracement upon retracement. So what I wanted to grab from this introduction to market structure is this. Lows, if market is going trading higher, recent lows are going to be protected. But if market is trading lower, recent highs are going to be protected until that recent high or recent low is taken out, and then a retracement is going to happen. Only this is not going to give you a context. But by the time you bring everything together, you're going to have the context, and then you will know what next to do to take the trade. Now, let us dive a little bit deeper into assuming let us, probably go into if in 1 hour time frame. Let's see if we'll be able to come up with a good explanation of diesel time. Now, remember, I'm still going to mark my long-term swing highs and my long-term swing lows. Okay, I'm letting this A here because it doesn't really matter. Okay, so I'll go to 1 hour. It's actually a very good one, and then I'll scale down. You can see what is happening here because well, we're in the 4 hour time frame. This whole thing was small, but I will scale that 1 hour and it's so big. Okay, so let us try to mark out something here. Let's try to mark out something here from this leg to this leg. Yeah. So, where should our long term swing low be? Here. And this remain a long term swing high because it is a retracement. Okay, now look at what happened. During the process of coming down here, there were highs, they were protected. For instance, this high, it was protected. Now, this is retracement. Okay. So I use this guy. So the market during the retracement traded all the way from this high to this low one, and then traded a lower high, a lower low, a lower high again, and then a lower low. Bear in mind, what I want you to understand is this. In the process, you see the internal highs, because the market was traded down, because the intention was to drive the market a little bit to the downside. Forget about the recent position we had here. This is now a bigger picture. Now we are in a smaller picture, 1 hour time frame from 4 hour time frame. So because this market was driving to the low side, okay, these highs were protected. This figure protected, and then we broke this low, the downside, retraced back a little bit. The market didn't come all the way to this upside. What I want you guys to grab is this, okay? The internal swing, the short-term swing highs are being protected, but the short-term swing lows are being taken out. But what is the real move? This is the real move here, from here to here. That is the real move. That is the big picture. That is the major swing. And until this major swing is met, like I said earlier, the internal swing points are going to be protected. Okay? So once we break above a recent swing point, it means the market has changed its direction. And that is what we call trend change or change of character. Or is it? It's far gone. That is what we call trend change or change of character. Yeah, where is it? Where are you? Yeah, it's chalk here or TC. Trend change or change of character. Can you see what I drew initially? Now, if you look at it here. Fine, beautiful. It's showing. It's showing. Yeah. Look at the swing here. This direction. We got to this level. This one here. Push down a little bit. We took out this guy and then we push down. There we go. So if I to scale that to the 1 hour, you see that it's almost the same thing that I drew earlier. That is still here. There you go. Did you see? There you go. So what you must have in your mind is the internal swing points are going to be protected as long as we have a directional bias somewhere we're going, because the market structure leads to direction. Okay. Now immediately we broke above this high here. Okay. You see it? After this after this mission was completed, we took a deep retracement by breaking a recent high. And then after much, whatever it is, all these highs here were being protected. So there, this level here. So I take this, I'll take the middle. And then came to this level, this guy here broke down. So the internal sweep points, you see, they are being kept. So until a recent low is being broken, yeah, the internal swings are going to be maintained or protected. That is that is the value of the introduction to the market structure. And what I want you guys to learn, that is it. Okay. So what is market structure in general? The market structure in general tells us the direction of a particular trend at a period of time. So remember, the market is fractal in nature. Whatever I display here, if I zoom to a lower time frame, you're definitely going to see something similar to that. Okay. I hope this video makes a lot of sense to you. But as we, continue, I will make sure that I break everything into pieces and tell you what is what. This is just the introduction, like I said earlier. To get the best out of this particular episode, please go on to the introduction to the series and then try as much as possible to complete the candidate anatomy. And then we will see in the next part of this episode too. Until then, cheers.